Breaking news from Washington as President Trump sends shockwaves through North American trade relations. The White House has declared a 25% tariff on Canadian imports, citing national security concerns and border control issues. The decision has ignited controversy across Canada, with Prime Minister Justin Trudeau declaring everything is on the table in response. Premier Doug Ford has suggested countermeasures including potential bans on American liquor imports and possible restrictions on energy exports to Michigan and New York. This high-stakes economic situation is particularly complex due to the deeply intertwined U.S. and Canadian economies, especially in energy. American refineries in the Midwest and Rocky Mountain regions depend heavily on Canadian crude oil. Any disruption could trigger a spike in U.S. gas prices and impact both economies. Meanwhile, China is orchestrating a major shift in global energy markets. U.S. crude exports to China have plunged from 115.6 million barrels to 81.9 million barrels. Beijing is redirecting their oil purchases to alternative suppliers, including Russia and Iran. China has implemented retaliatory tariffs on U.S. energy products, 10% on crude oil and 15% on LNG and coal. This strategic pivot has knocked the U.S. from China's second-largest oil supplier to sixth place. The world's largest oil importer shows a 7.2% drop in crude imports, but this isn't just about reduced demand. Beijing is strategically diversifying its energy sources, turning to politically isolated suppliers offering cheaper alternatives. This reshaping of global energy alliances could have far-reaching implications for international trade and diplomatic relations. Breaking news from global energy markets reveals China's bold strategy to reshape international oil trade through shadow purchases from sanctioned nations. Our investigation uncovers complex maritime maneuvers and partnerships sending shockwaves through energy markets. According to data from energy tracking firm Kepler, China's oil imports from sanctioned countries have risen significantly. While a 2% increase seems modest, applied to China's daily import volume of 10 million barrels, it represents substantial quantities reshaping global energy dynamics. Following Western sanctions, Moscow has been offering steep discounts on Urals crude, and Beijing has seized this opportunity. Sources reveal a network of ghost ships, Iranian tankers that disable tracking systems in Malaysian waters, where they transfer oil to other vessels. What we're seeing is unprecedented, says energy analyst Marcus Thompson. These ships play a maritime shell game, with oil transforming from Iranian to Malaysian or Omani origin before reaching Chinese ports. Venezuela has joined this trade network, using complex payment systems and third-party traders to circumvent sanctions. Smaller Chinese refineries are the primary beneficiaries of these discounted supplies. This isn't just about savings, it's strategy. By diversifying suppliers away from Western-aligned nations, China builds energy security while securing cost advantages. These savings allow Chinese refiners to flood markets with cheaper products, strengthening Beijing's influence. Traditional suppliers like Saudi Arabia, Angola, and Brazil have been forced to adjust pricing to remain competitive. Western attempts to enforce sanctions face challenges as China's appetite for discounted oil grows. The implications are clear. China's strategic pivot is fundamentally altering global oil markets, creating new power dynamics that could reshape international energy trade for years to come. Breaking news from the global energy sector reveals a massive shift in international trade alliances, with Russia pivoting eastward following sanctions. This strategic realignment has resulted in unprecedented trade volumes between Moscow and Beijing, reaching $240 billion in 2023. Russia's survival strategy has evolved into a comprehensive overhaul of its energy export model. By offering significant discounts on crude oil, Moscow has positioned itself as China's premier energy supplier. The completion of the Power of Siberia pipeline in 2024 marked a crucial milestone in this partnership. Plans are underway for Power of Siberia 2, which would redirect gas flows originally destined for European markets. This development signals a restructuring of global energy dynamics, with Russia becoming increasingly dependent on Chinese markets. Beijing's energy strategy extends beyond Moscow. Despite U.S. sanctions, China has maintained oil purchases from Iran at discounted rates, providing a crucial financial lifeline for Tehran. Even with tougher sanctions in October 2024, China has maintained these energy flows. China's energy relationship with the UAE has flourished, with total trade reaching $95 billion in 2023. While non-oil goods dominated at $83 billion, energy remains fundamental. The UAE's natural gas exports to China topped $4 billion that year. A deal between China National Petroleum Corporation and Abu Dhabi National Oil Company in mid-2024 strengthened these ties. This partnership includes exploration, production increases, and enhanced trade in crude oil and liquefied natural gas. China's dual approach, securing traditional energy sources while positioning itself as a clean energy leader through solar technology exports to partners like the UAE, demonstrates Beijing's determination to dominate both conventional and renewable energy markets. In a dramatic shift reshaping global energy markets, China's pivot away from U.S. oil imports is sending ripples through international trade. The United Arab Emirates has increased its investments in China, with a 120% surge in 2023, representing nearly 90% of Arab capital flowing into China. China's deepening energy partnerships with Russia and politically isolated nations isn't just about cheaper oil. It's a calculated move to reduce dependency on Western-controlled markets. As Beijing strengthens ties with Moscow and Tehran, American energy producers face an increasingly challenging landscape. China's transformation from energy self-sufficiency to the world's largest oil importer is significant. In 1993, domestic production couldn't keep pace with industrial demands, forcing China to begin importing oil. By 2023, China's daily oil imports reached 11.3 million barrels. The implications for U.S. energy producers are substantial. Lower demand for American oil could drive down crude prices, impacting profits, investments, and jobs. This shift, combined with trade tensions, has accelerated Beijing's search for alternatives to U.S. energy sources. China's Belt and Road Initiative expands Beijing's influence while creating a self-sustaining system less vulnerable to global pressures. The growing energy alliance between China, Russia, and Iran represents more than economic cooperation. It's a strategic realignment that could alter global trade dynamics. For American investors and energy sector workers, this shift raises questions about U.S. oil exports and trade relations between the world's two largest economies. As China diversifies its energy sources and invests in renewables, the global energy landscape is undergoing a transformation that could reshape international power dynamics for decades. In a significant shift reshaping global energy markets, China's strategic moves are creating waves that could fundamentally alter America's economic position. Beijing is pivoting away from U.S. oil markets, embracing alternative suppliers, primarily Russia and Iran, at heavily discounted rates. These transactions are increasingly conducted outside the traditional dollar-based system, challenging the petrodollar framework that's been a cornerstone of American economic power for decades. The implications for American oil producers could be severe. Industry experts warn that reduced Chinese demand might create a surplus in the U.S. market. While this could temporarily benefit consumers through lower prices, the long-term consequences for our energy sector could be devastating, including job losses, reduced investment, and compromised profit margins. China's growing alliance with BRICS nations, particularly its strengthening ties with Russia and Iran, suggests the formation of a new economic bloc operating beyond Washington's influence. This development could significantly weaken America's ability to leverage economic sanctions as a diplomatic tool. The numbers tell a compelling story. Petroleum remains one of America's major exports, and any sustained reduction in Chinese purchases could further destabilize the trade balance. Beijing's strategy appears focused on achieving energy independence while reducing its exposure to U.S.-controlled markets. As these developments unfold, it's clear we're witnessing a historic shift in global economic power dynamics. The question isn't whether change is coming, it's already here. The real question is how far this new energy world order will reach and what it means for America's global position.